Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Welcome back to some easy listening on the Australian Investors Podcast. Today I'm joined by a very special guest, my groomsman, Ryan Newman, who is portfolio manager at the Motley Fool Pro here in Australia. Mate, welcome to the show.
Thank you very much for having me. Great to be here.
Yeah, it's heaps of fun. So we're going to try and keep it PG for listeners today. And for viewers, if you want to watch this, you can jump on the Rask Australia YouTube channel, where you'll see a lovely photo or video of Ryan and myself. I'm much more casual than you today, Ryan. You've got a nice analyst.
Yeah, I've come prepared in my Motley Fool, my Motley Fool getup.
Yeah, you have.
I feel a lot more dressed up than you. I feel like you could have gone to a bit more effort there.
Yeah, I was just explaining that I bought this Levi's top, and then within 5 minutes, literally, I wore it home from the Eastland Shopping Centre, and I spilt something on it, and now it's stained for life. It's the most expensive shirt I bought in 18 months. Anyway, we digress. So today we're going to talk about your investing journey, some of the things that you've learned over the years, and we're going to talk about like who's influenced you, the types of companies you like to invest in, why you invest in those types of companies, and you've even got some examples for us. But to kick things off, people who don't know you may not know, well, they wouldn't know that you are a St Kilda tragic in the AFL. I'm surrounded by St Kilda fans, you being one of them. And so I thought I'd just to break the ice with you, mate, just some easy questions straight off the bat. You can play them. So I guess, what are your thoughts on a drawn grand final, and what's the best solution to that?
I thought you were meant to ease into these sort of hard questions. Look, tragic is definitely the right word. It's been a tough journey. It's been a tough 29 years of existence for myself. I think the drawn grand final, that was probably the best and the worst game I've ever seen. It was heart stopping. It was an amazing game, but at the same time just heartbreaking. You know, to get so close and yet so far. There was obviously that moment as well with Brendan Goddard taking that, specky right. I think it was the last quarter or maybe the third quarter, and just thinking, this is it. This we've got this, and then just to have it taken from our grasp, that was pure devastation. That's all I can say.
Yeah, well, I mean, St Kilda fans, my experience with them is that they're often very good people. Maybe with the exception of one or two who shall remain nameless. I've got to admit, like, you guys, you'll have your time in the sun. Hopefully next time you won't have two grand finals in one season. But the other question that I have is for those who are St Kilda fans or AFL fans, I've just got to ask the question, is Steele better than Lenny Hayes?
That's a good question. He's an amazing player. He's sort of a pretty similar player as well. Very, very tackle oriented, very defensive, but also putting in that offensive work too. He's an amazing player, and I think as well with the struggles that we've had this year, and we're starting to look good, by the way. We've had some pretty good weeks against Richmond and Brisbane in particular, but he's been leading from the front all the way through, and yeah, I'm more than happy to have him replace Lenny. Lenny's up at Greater West Sydney now anyway, so we do need a replacement on the ground.
Yeah, fair enough. Okay, so I like it. Yeah, and we'll watch on. We're recording this in early to mid-July. We'll see if you guys make the finals. I hope for your sake, mate, and for those around me that you do. But let's get on with the actual interesting stuff rather than St Kilda. No offense, I'm a Hawks fan. So what I want to do is talk to you about your journey to investing, because you mentioned there that you're actually quite young to be a portfolio manager at 29. So I guess, where did it all start for you? Can you relive that experience for listeners?
Yeah, it's interesting to call it my journey. In a way, I almost think of it as our journey.
Hmm.
For those who don't know, Owen and I are very good friends. We went to school together. So we grew up in southeast Melbourne. Actually, would you call where you grew up southeast Melbourne,
Yeah,
Dandenongs,
yeah, East
Eastern?
Melbourne. Yeah.
Yeah, so I'm from southeast. Owen's from the hills. We both grew up together. We both met at St Joseph's College in Ferntree Gully. Um, to be honest, I don't know if you know this. I didn't really take to you early in the early days. I don't know if I can say this on here, but to be honest, I thought you were a bit of a prick. But
We may as well
you
say
really
it
want.
here with thousands of people listening.
That's right. No, but look, I really warmed to you, particularly in the later years when I guess we started to develop some pretty similar interests. I know we were both really into our fitness and gym. I think, to be honest, probably what brought us together. I think you were probably looking for some tips and some pointers about how to improve your technique and form. So I was happy to give that to you, mate. Um, but yeah, I think that was probably really the starting point, and also sitting through specialist math. That was an interesting tale.
Yeah.
I think you were probably better at that than I was. But yeah, that was really, I guess, the start of our journey, and we really kicked it on from there. After school, I think I I guess after school, it is a difficult period for a lot of people. I think you probably felt that as well. I know you sort of had trouble finding your direction. You ended up living down in Anglesey for quite a while and studying in Geelong. I can't even
Mhm.
remember what you were studying down there, to be honest. But
Engineering.
engineering, there you go.
Yeah.
So it's amazing that we've both come to this point, and I think we've sort of shared some experiences along the way. I remember, for instance, you got me one of my first jobs, Foodworks in Upwey.
Hmm.
Do you remember that?
Yep. You were instantly the manager of the store. Must have put in a good word for you.
Yeah, that's right. To be honest, I didn't last long. Retail was not for me. I remember Ken was our manager, and amongst his final words to me were when I handed in my resignation. Wow, already? I knew at that point that I wasn't going to be one of the employees to remember. But um, yeah, from there, I think it was difficult to know what direction to take. And I started off in commerce. I really liked the idea of maths. Actually, all through school, I was actually really good at maths. Specialist maths didn't grab me. I wasn't very good at that, and that's the more advanced sort of side of things. But maths, I was always very interested in that. My dad's an accountant as well, and I guess going down that commerce and accounting sort of path just seemed to make sense to me. But when I left school and got into university, it just really didn't agree with me. I think I needed that break, that mental break, to just sort of take it in and just live life for a bit. I was actually working at a local hospital or a private hospital at that time as well. And was interested in potentially going down the medicine path. I was sort of going through some health courses to get to that. Realized I couldn't stand the science element of it, and it actually ended back up in accounting. Um, from memory, you and I actually sort of went down that path at a fairly similar time. I know I actually joined you at an RG 146 course, and that's a regulatory sort of course. So I'm not
Mm.
really sure why we ended up in that. And I'm going to throw this back to you. Why did we end up in that? Because
I
I
think
actually sort of followed your lead on that one.
I think at the time, and this is a maybe a blight on the financial planning industry, is at the time you could go into a major city and pretty much get RG 146 qualified. So that's Regulatory Guide 146, and what that means is that then you could give financial advice, and we recognized that you could effectively become effectively a financial planner in like 2 weeks. Uh, which now that I say it is very scary to think that early 20s young folks without any qualifications or experience could have had that kind of title. Um, but yeah, I think we did that, but I don't know if that came first. I think what may have came first is actually reading or you reading the Motley Fool, finding out about the free newsletter that they offered at the time.
Yeah, maybe that did come first. And the Motley Fool's been around in Australia for, I think, about 10 years now. It might be a year or two either side of that. I did come across it in the very early days, and investing was always something that interested me. I remember probably 15 or so years ago, I was sitting at a family barbecue and talking to my uncle about the prospect of potentially investing in JB Hi-Fi shares at the time. And I didn't, but I remember they were trading it, I think it was around $2 at the time. And JB Hi-Fi was my favorite store to go into. I regularly go in there and buy a DVD, or buy my hardware or whatever I needed at the time. So it was something that sort of resonated with me, and I thought, yeah, hey, I really like the idea of owning some shares in this. I didn't, but I guess that sort of sparked the interest for me. I'm going to digress for a little bit because, and we're sort of going all over the shop here, but I said that my journey sort of started off as our journey, and that is literally speaking. So I remember the first stock that I bought.
Here we go.
Do you remember the name of the stock that I bought?
I don't remember the name. Maybe something to do with Indonesia and mining?
Yeah, that's pretty much spot on. It was called Indo Mines. IDO was the ticker code. I don't think it's listed anymore.
Oh, no.
Now, and for your listeners and my listeners, anyone who's got any vested interest in either of us, we have both come a long way since this point. Rest assured. My first stock, I literally opened the newspaper to the financial section, and Owen was around at my place for the day, and I said to him, "All right, mate, I've got $500 to invest today. What am I going to buy?" And Owen's advice, and this was your advice, you said, "All right, I want you to close your eyes. I want you to point randomly somewhere on that page, and whatever you point to, that's the stock that you're going to buy." So sure enough, Indo Mines was the first stock that I bought. I actually made a little bit of money on it. I think I made about 20% by the time I sold. I was actually a forced seller. I done sent in an order to sell it at this price, and I think it triggered that after maybe 2 or 3 months, just by pure chance.
You're welcome.
So I made a bit of money on it. My second stock wasn't quite so successful, and this was also a Rask recommendation. That company was called Hot Rock Limited, and now if I recall correctly, you were pretty much that guy at the barbecue that gave us that hot tip about this hot stock. So maybe you want to give us a bit of information about how you came across that.
Yeah, so it's very scientific, so I won't bore you with the details. But basically, Hot Rock Limited was involved in some geothermal energy extraction based out of Latin America, I believe. So, I mean, all good things, well within our circle of competence at that stage. You said you didn't like science. Geothermal energy sounds like something that would be right down our alley. And yeah, I think I got you involved in that one. Too bad I didn't judge commission because, I mean, yeah, who knows where I'd be today. But so what was also tragic about this, I mean, I eat my own cooking even back then as I do now, but I went pretty hard into Hot Rock Limited. Not only that, but I also ended up investing some of my mother's money into Hot Rock Limited. And I convinced you to do the same. Mm-hmm. So, yeah, that was I guess just like a 3-time loser in every sense of the word. I don't know, but did it actually end up going bust, or what happened to that?
I have no idea. I sold within a couple of months, I think. The volatility was too much for me at that point.
Yeah, well,
it was a roller coaster.
Yeah, you've got to hold on to the great companies, I guess.
That's right.
Yeah, so that was a pretty formative experience for you, no doubt.
Yeah, look, it's a funny experience and one I look back at fondly. But the truth is, I don't regret it. It was a good lesson to learn early on as an investor, and I think that's a real key. The best time to start investing is 10 years ago, but the second best time is now. So I believe that for anyone can start investing at any time, whether it's today, tomorrow, whenever. But the best time to do it is when you are young and when, I guess you're investing with money that in the big scheme of things isn't going to make a huge difference in your life. And as I said, into Indo Mines, that was probably a $500 investment at the time. And at the time, that seems big. It's devastating to lose that or to even potentially lose that. But looking back now, it was well worth risking that or making or learning that lesson then, as opposed to now when you've got a family to look after or a mortgage, or whether I guess the stakes are that much higher. So it's not something that I regret at all. I think, though, it was probably not too long after that I started really, I guess, trying to find, some better advice and some better guidance on how to actually, go about my investing. I was looking for some newsletter services at the time. Maybe I just came across a newsletter service by chance, when I was looking for some stock news, for instance. And there were a few offerings at that time, and I can't remember the exact names of them. The Motley Fool, though, was one of probably 3 or 4 that I sort of shortlisted. I think there was maybe like a free month subscription, sort of a trial period, and I probably did that for each of those 3 or 4. And I was tossing up between these different newsletter services, and I think one of the reasons that I landed with the Motley Fool at the time, for one, it was only just starting in Australia, so it was a pretty new experience. I was starting as an investor; they were starting in Australia, so it sort of felt like I was starting my journey with them at the same time. It was partly the cost, as I said, as a young investor, money and cash was a lot to me at that time, as it is still now, but even more so at that time. And also the brand and the messaging resonated with me. Wasn't a really, this company wasn't taking itself incredibly seriously like others in the industry do, like yourself obviously do. This is meant to be a very serious chat, I'm sure.
No doubt.
But the messaging and the branding really resonated with me. The Motley Fool with a jester cap as its logo. That resonated with me, and I think that's really why I joined as a member to the free site initially, and then I think the first service was Share Advisor, which is still going. But at the time, as I said, it probably only recommended 1 or 2 stocks at that time. So I remained a member for a number of years, probably 1 or 2 years, I guess. And then I realized, hey, I actually really enjoy this, and I think this might be a path that I want to go down. I was studying accounting at that time and thinking, this is something I want to do. I did initially send Bruce Jackson is our general manager, still is our general manager. His wife was also working at the company at that time. Her name's Lynette. And I sent the company an email and basically said, look, do you guys have any open opportunities? I'd be really keen to learn and really keen to join in. At that time, she said, look, I really enjoy your enthusiasm and your, I guess, persistence. At this time, we don't have anything. So, please keep us in mind, maybe come back to us in the future. As I said, I was working at a hospital around that time, went back from London. I was visiting my brother over there who was just on a 3-month trip. And when I came back, I guess I struggled a little bit getting back into the work. I wasn't getting the shifts that I needed or wanted. So I messaged again and said, look, do you have any opportunities now? And they said, still no full-time opportunities, but we do have some freelance opportunities. Would you like to explore that? And yeah, I jumped at the opportunity. And that's where I really started, I guess, as a freelance writer for the Motley Fool. I think that was February 2013. So just over 8 years ago now.
Mm. Yeah. I didn't realize you had to be so persistent. That's pretty cool. I suppose when you want to do something, you got to ask and ask again.
That's right. Yeah, it's a good lesson.
Yeah. Yeah. So it's kind of interesting how that took place, and I guess changed the trajectory of your life, which in turn then changed the trajectory of mine. Because, and I think I'm going to pay my dues to Bruce here, the Motley Fool at large, but Bruce in particular, who is the general manager of the Motley Fool Australia. He goes unnoticed. He's kind of like behind the scenes, right? And he's, from the get-go, he's understood what people want. He's built a platform that's incredible, and he's provided a place for people like us and others in the Motley Fool team to learn about investing and then share that wisdom with more people, with thousands of people around Australia and indeed the world. And so it's funny, how we trace a path through life. because the next step for you was you started freelancing, right? And then um, I guess what were you doing when you're freelancing for the Motley Fool? What were you doing, and how did that change up until now? Like your role, I guess.
Yeah, so at the time, as a freelancer, it basically became my job. So I was basically writing all day. And it gave me a really good opportunity to start learning more about investing and about businesses, to not actually have to go to an office every day to work and then, come home and look at business, studies afterwards. Just being able to do that during the day and start, really, I guess, seeing how things work and how everything sort of flows together. That was a real eye opener for me at the time.
Mm.
Um, I was I want to say I was doing freelance writing for maybe 3 years, and at times I was writing, multiple articles a day. And as I said, that was really valuable for me. What I found though was that I guess being a writer, but I'll start by saying this: writing is an amazing skill for anyone,
Mm.
and I think as an investor in particular, because being able to write allows you to sort of think ideas through. It allows you to get them onto a piece of paper, and even if you aren't writing properly, even if it's a really, you're writing for half an hour and then you realize, oh, this is terrible. Even that is a good lesson, because you realize, hey, I don't actually understand this enough to write about it. I need to go back and double click into this and understand it better. But when you do understand it, writing it down sort of helps that idea generation sort of flow. So writing was incredibly valuable for me, and it still is. What I think was an issue for me, though, is that spending so much time writing, I wasn't getting enough time to read and really digest that information.
Mm.
And I think, and I, as I said, I transitioned from freelance writer to research, or to writer analyst, writer research analyst. I think in probably late 2016 or thereabouts. So after three and a half years. And what I found with the transition was that being able to read more and actually take that information in to digest it was really helpful. It allowed me to sort of start developing more of a, second level thinking. Not only what has been said or what is being said, but what do they mean?
Mm.
And even on top of that, it's not only what do they mean, it's also what did they not say.
Yep.
It's actually reading into this and starting to think more along the lines of, how is this business being run, as opposed to, how are they saying it's performed. So I think that's a really valuable skill to learn, and one that I think is valuable for any investor, but particularly ones that are, I guess, working in the industry like you and I.
Mm.
Um, I think one of the challenges that I had, actually, of transitioning from a freelance writer to an analyst, it was probably feeling like I wasn't doing my job. I'd gone from a very hands-on, I'm constantly writing, to now I'm constantly reading, and I'm not. There's really not that much, tangible output, or there's nowhere near as much tangible output as I'm doing right now as I was. And in a sense, that was hard to, I guess, comprehend, that
Mm.
I am creating, or I hope I'm creating more value now by doing less work and more thinking. And that is something that I had to sort of adjust to and learn, probably over the course of maybe 12 months, that, hey, this is what I should be doing. This is what I need to be doing.
Mm. Yeah, I've I remember the freelancing days, and it was like 80% writing, 20% research, right? And then you go into a research role, and it's flipped the other way, if
Hmm.
not more research. Um, it's fascinating to hear you talk about it, like because we've shared so many similar experiences. Um, to hear you talk about it resonates with me, and just to hear you talk about it and explain it is actually really good to hear, because I often say that writing is such an important skill set for investors, because you
Hmm.
get your thesis down, you can fill in the blanks, like one of the things that I kind of talk about a lot is the Feynman technique. It's basically where you kind of research, you explain it to a child effectively to try and fill in the blanks. Then you go back and you research, and then you try and do it again until you fill in those blanks. Writing is a great way to do that without a child. I'm sure you'll be doing that in a few years with your kids, but yeah, I think it's such a useful and valuable skill. Like all of the good investors are great writers, right? So Warren Buffett, Charlie Munger, Howard Marks, the list goes on. Okay. Do you remember, this is a question that one of the Rask team put to me to ask you is, do you remember like any books or resources in particular that influenced you in those early days where you thought, oh, maybe you had an aha moment or anything like that?
Yeah, I've got probably three that resonated quite well with me. The first one's going to be a boring answer. It's probably the answer that a lot of people give. One Up on Wall Street by Peter
Nice.
Lynch. That one, I think in the early days, what probably, I guess, hindered my development a little bit was really thinking about stocks in terms of a business. And it's obvious to you and I right now, right? But people that you and I talk to that maybe not so experienced in investing, they don't comprehend that, and it is really difficult for them to comprehend. What is a stock? What is a share? What does it represent? And you and I were actually trying to explain this to a tradesman recently, and putting it in terms of, if you were to sell some of your business to someone else, then that is sort of like a share. If you sell $50,000, or if you sell a share for $50,000 and you keep one for $50,000, your business is valued at $100,000. You own one share, he owns one share.
Yep.
People don't comprehend that. And I can understand why, because I sort of came from that point. And reading One Up on Wall Street, I think for me was just a good start, a good place to start, because it really did highlight investing in that light. Invest in what you know. Think about the business, observe the world, and take it in. I haven't read One Up on Wall Street in a number of years, so I can't remember any of the specific case studies. But he does refer to a lot of situations where he has observed, for instance, a cafe that might have just opened a second franchise, and then another franchise, and then another one. And just being observant like that and taking that in, that can be a real good starting point for you. And it's not even just that. If you're a worker, you can actually start to think about investing in that light as well. Let's say you're a young cashier at Woolworths, right? So you work. That is one of the company's major expenses, the employment. What happens if all of a sudden the company creates some sort of, or the company introduces some sort of new innovation that all of a sudden you notice, I'm able to pack these bags twice as fast as I used to be able to. That's an efficiency improvement. That's an improvement in efficiency, right? So maybe that means that Woolworths can hire less staff on any given shift. Maybe that means that their expenses can go down while their revenue stays constant, which would therefore lead to higher profits. It's those sort of insights, I think, that can be really valuable, particularly for people who are just starting out. And there's a whole lot of different examples of that. If you're working at a cafe as a barista, and as I mentioned a minute ago, your boss opens up a second franchise, and then another, and then all of a sudden it's 100. Extreme example, but it's taking that sort of information in. It can give you an advantage over other people in the market who may not necessarily be looking for that immediate, factoid. Another book that I read later in my journey, still a number of years ago, but not directly at the beginning. It was a book called The Talent Code by Daniel Coyle. And it's basically about practice. 10,000 hours of practice and focused practice, sort of helps you perfect an art or a skill. And that applies to any area of life, right? So there's different chapters in there devoted to I think it was maybe a Serbian or Croatian tennis team that pushed out a number of number one world players from this one club. And it was really interesting to learn that the way they actually start practicing in that club, it's not by, hitting balls. It's by literally just swinging the racket with an invisible ball. So they would literally start with an invisible ball and just practice that swing. And then as they develop that skill, that's when they introduce the ball. How does that apply to investing? I think as a young person trying to break into a highly competitive market, as I was, as you did as well, against people who have been doing this for years and decades even, it can be difficult to sort of see, how am I actually going to make it in this industry? I really need to put in the work. And the lesson there for me was, one, keep applying yourself just over and over and over again. Just keep on trying to perfect that art. In other ways that it can be applied to investing as well, I think just reading earnings reports, reading this, reading that, reading the next one, business briefs, building models, watching interviews, and then also conducting them. By just spending time doing these things, you can start to really perfect that skill. And, and it does become second nature. And you find that you start just really thinking, in a sort of business mind. You're from that mindset. Someone might mention, as I said, someone might mention from Woolworths, hey, they introduced this thing and now it's so much easier for me to pack these bags. I'm not getting as much wrist pain. It's great. From that point of view, you can start thinking, oh, hang on, I wonder what's going on behind the scenes there. Is Woolworths something that I should be looking at? Is the company that Woolworths that Woolworths got that innovation from something that I should be looking at? You start thinking in terms of business and how you could potentially back that idea or that investment. The third that I'll mention is called The Tipping Point by Malcolm Gladwell. And I think what really resonated with me from that book is that the human brain is designed to think linearly, so in a linear fashion. And it is really hard to think in terms of exponential growth. So I'll give you an example from the book. If you were to fold a piece of paper 50 times, and this is impossible, mind you, I think that the maximum number you can fold a piece of paper is seven or eight. But just hypothetically speaking, if you were to fold a piece of paper 50 times, how tall do you reckon that stack would be?
Are you actually asking me? Because
I'm asking you, yeah.
I think I read your update when you wrote about this. And
okay, so all right, so don't bother then.
Okay.
You ruined it. No, look, when you hear that, I think it's probably reasonable to think, oh, look, I would imagine it'd be, as high as the ceiling. The actual answer is it's about 3/4 of the way to the sun. It's millions and millions. I think it's about 128 billion miles or something like that, which is just astounding to get your head around. A piece of paper that's 0.1 millimeter thick, folded 50 times, and it gets 3/4 of the way to the sun. Again, impossible, but hypothetically speaking, you don't think like that, and your brain isn't designed to think like that. And the same applies to investing. And in particular, the companies that I look at and the companies that my team and the teams that I'm in predominantly look at are growth stocks and companies that are capable of generating substantial growth over time. And one of the areas that you can potentially get an edge on others in the market is just by, I guess, imagining how that company could continue to win over time that others in the market may not necessarily be doing. So if you build a model and you estimate 30% growth next year for this business, it's pretty difficult to imagine that company growing 30% in the year after, and then 30%, and then 30%, and then 30%. A company like Amazon has done that. They've done that, I think, at 20 or 25% for a couple of decades now. But typically, most companies don't. When you find a company that you think could do that, while others in the market might be thinking, all right, they're going to grow at 30% and then 28% and then 26%, 24%, so on and so forth, sort of that deceleration, you can start to think about, hey, is there potential for this company to actually maintain or sustain that rate of growth or a higher rate of growth for a longer period of time? that could potentially make this this company more valuable than what the market is currently attributing to it. That was probably my biggest lesson from the tipping point. Just to think about how you could potentially get that edge over other investors and others in the market.
How do you, when you forecast companies today, do you forecast using percentages, like is in like simple percentages for growth, or do you do it like, is there other ways you think about forecasting generally speaking?
Yeah, I do generally go with percentages. Look, it varies depending on the company and depending on the issue, right? But there are some instances where I think you can, get a pretty fair idea or a reasonably good estimate, and that's all you're ever doing when you're forecasting, right? It's all just estimating, but you can make it an intelligent estimate, one that's backed by facts or backed by trends. And one of the ways that you can do that is, I guess, by starting to put together numbers or figures that, you might see that a company might be broken down into 3 or 4 different segments. You might see that this segment is this segment's growing at 150%, and that's amazing growth. And you think that's going to be a really good growth driver for this company in the future. So you can look at that, and then you can look at that in contrast with other segments within that business. And that another segment might be growing at 10%, and another segment might be growing at 20%. And you can sort of look at how these different segments make up the big business. The biggest part of that business, or the biggest segment, might be growing at 10%. So you can sort of see, all right, well, that's going to create the biggest weight for this business in the next year. So growth might be 12%. But I guess peeling back that layer and then sort of forecasting growth for that underlying segment, 150%, maybe 140% the next year, and 130% the next year, that will actually start to have a bigger impact on the underlying business and the overall group. So you can start to look at that and break that down and think, all right, well, overall, this group might grow at 12% this year, and then 13% the next year, and 14%, and so on. I think when it comes to when it comes to forecasting, it does pay to have some leniency in mind that you're not going to be right. Any estimate that you make will be simply a star in the galaxy. You could pick any star in any galaxy. You've selected this one as your estimate, so it's not going to be right. It's not going to be spot on, but you can be in the general area. I think when it comes to these sort of businesses, you need to pay particular attention, I think, to what you think is reasonable in the next few years, maybe 2 or 3 years, and then you can start to, I guess, be a little bit more lax for years 3 onwards. For the companies that I estimate for, generally I'm going out to 10 years. Obviously, at that time, your estimates are going to be they're going to be likely way off from what is reality, but one of the reasons that I do go out so far with those companies is I also think that it's unreasonable to expect such a sharp drop off in growth so soon. And I guess to give you an example of that, let's say you're going for 30% growth this year, slowing down to 20% growth in 5 years' time. After 5 years, it would probably be unreasonable to expect that company to slow down to a terminal rate of growth of 4%. So the reason I go out to 10% is so that I can sort of slow that growth down or decelerate it over a longer period of time. I hope that answers your question. Generally, it is percentage based. Generally, there is an element of deceleration in there. Depending on the company, I will generally forecast a varying rate of deceleration. I think what is probably standard is 20% deceleration, between 15 and 20% deceleration per year. I think that's reasonable for some companies. I think some other companies, a much slower rate of deceleration is appropriate.
All right, seeing that you got nerdy on this, I'll ask a follow up. So, how do you select your discount rate then when you do your valuations?
I'm not super strict on it. So, the general rule that you would apply is the WACC, the weighted average cost of capital, and you would look at the cost of equity as well as the cost of debt. So by taking on debt, a company can increase its risk by taking on debt. in terms of its balance sheet position. But at the same time, if debt is cheaper than equity, which it is, then it can actually reduce the cost of capital. I think if you were applying that to a mature sort of business, maybe like a Woolworths or a Telstra, I think going by that WACC approach would be reasonable, and I think others in the market would be doing the same. Those sort of companies would have, dozens of analysts following them. When it comes to a smaller growth company like the ones that I typically look at, I'm not as liberal with my calculation. I'm more generally applying, I want 15% for this. I'm taking on a higher level of risk here. This company has balance sheet risk. It has cash flow risk. If I'm going to invest in this business, I want to make sure that there is a good margin of safety in the price that I'm paying to make that a profitable decision. So if I require 15% for that return, or 17%, I think I've gone up to it with some businesses, then yeah, I'll plug that into my model. And for those who are listening, a discount rate is basically that, a required rate of return.
Yeah, I think that's the easiest way to think about it. Required rate of return. Okay, here's a question for you. So you're portfolio manager of Motley Fool Pro. Gone before you, we've seen Joe Magyer, who's now at Lake House Capital. He's been on the show. Friend of the show, it's fair to say. Friend of ours too. Matt Joass, who's now running Maven. Anirban, who is my co-host for the Investors Podcast now. And he's also still investing at Seven Investing. This is a kind of let's play favorites question. What have you learned from any of these people in your time working with them or alongside them, or just being around them?
I've been incredibly privileged to be around them, pretty much from my early days at the Motley Fool. So when I transitioned from freelance writer to writer analyst, the position in 2016 or thereabouts, Joe pretty much became my mentor, and I learned a lot from him. It was unfortunate that I didn't get any time actually working with him on Pro. By the time I joined Pro, he had left, and it was Matt that was leading. What was really beneficial though is I see a lot of similarities between Matt and Joe. And I think that probably stands to reason because Matt was also serving as analyst under Joe when Joe was the portfolio manager of Pro. So I think he learned quite a bit from Joe, and he's obviously adapted his approach in the time since, as has Joe. But they sort of followed the same philosophy, so to speak. So I do see a lot of similarities between them. I think the small cap focus was one of the big things for me. So Joe, which might surprise a lot of investors now, but he started off as a value investor and then really transitioned to become growth oriented, because he saw the appeal of investing in businesses that would be could be tomorrow's blue chip, so to speak. So not backing those value plays that you sell it as soon as it hits your estimate of intrinsic value, but investing in businesses that have such sky high potential that, I guess in some senses, the intrinsic value in a way becomes less important because the range of outcomes becomes so much broader. So the small cap focus is one element, and the long-term focus as well. So not selling your winners too soon, and also trimming your weeds. As a young investor, probably one of the biggest mistakes that I made as an investor. I remember I was working at a previous job, and I saw one day that a company that I owned went down 20%, just like that, after an announcement. Likewise, another company that I owned went up by 20% on the same day. And I can't remember why they both moved in either direction, but at the time I was thinking, this is great. I'm going to sell the one that's just gone up, and I'm going to buy the one that's just gone down, and buy more of the one that's just gone down. So I ended up with one position that was, on the downwards trend, and it did continue that path for quite some time. It's actually rebounded a lot in the time since, but I did sell because the business was underperforming for quite some time.
Which company was it?
It was a company called Coden.
I,
CDA or CDN, I think is the ticker
yeah,
code.
they did gold mining detection back in the day.
Yeah, that's right. Yeah.
Yeah, I think it's transitioned a bit since. Yeah, cool.
So that was the company, and the company that I sold that went up was actually corporate travel management, which has obviously not done so well throughout this pandemic, but it has been a long term winner, and would have been a very long term winner for me had I held. So I think one of the lessons that I learned from these guys was that that long term focus and that, I guess, willingness to hold on to your ones, the winners, the ones that are actually winning for your portfolio, and selling the ones that aren't performing well. One of the other things that I really respect about Joe and Matt, both of them alike, is that their willingness to say no. And I think that's a really important attribute for an investor, because yeah, by saying no, you might miss out on something that's going to go up a few 100%. But successful investing is just about, it's as much about the companies that you don't invest in as it is about the companies that you do invest in. And I think if you have too many big losers in your portfolio, then you're going to struggle. If you do have a big winner in your portfolio and it goes up 20 times, then yeah, it's going to make up for a lot of those losers. But what that willingness to say no to leads to is a concentrated portfolio. And it goes against what a lot of investors feel comfortable with, having that diversification. Some investors will have 50, maybe even 100 stocks in their portfolio. They're not willing to add to existing positions because they would prefer just, diversify into something new. That's okay. But by doing that, you're pretty much committing yourself to basically to market returns, because you become so diversified that your portfolio basically becomes the market. By running a concentrated portfolio, yes, you do have more company-specific risk, so you do need to stay on top of those companies more, but it's less market risk, like less beta risk almost. Like you're not so concentrated on what the market's doing, but what these companies are doing. And by doing that, you can really focus your attention on the companies that you have the highest amount of conviction in. The companies that you've been following for a longer period of time. Also, by running a more concentrated portfolio, it does allow you more time to actually study those businesses and keep track. If you've got 100 positions in your portfolio, there's no way known that you're going to be able to keep track of them all. Whereas with 15, 20, yeah, it becomes far more possible, and you can actually start to almost build an expertise in those sort of businesses.
But what about the efficient frontier?
Yeah, there's that. We won't get into that for today, but there is that.
Yeah, sorry, mate. Go on. I didn't mean to interrupt with some shenanigans.
I think what else as well. So two other things that I took away from Matt and Joe, and I've taken a lot from them. They've given a lot to my investing journey. But two other points: gaining exposure incrementally. So buying in slowly to a position. You don't need to jump in with a 10% position right away. And that's what I was talking about a minute ago as well, with building conviction in a position over time. By managing a concentrated portfolio, you can build that conviction. So if you find an idea that you really like and you think this has real potential, you don't need to go all in straight away. You can buy a 1 or 2% position, sort of see how it goes. Maybe just have that as the sort of the very low end of your portfolio for a little while you do learn more about it. And then as you gain confidence, you can either say, as you gain more expertise in it, you can either say, I don't want any more of this, or I do. And then you can start to build that position over time. They did that really well, and I think they still do. The other thing as well that probably helped me to align myself with them is that, and I don't think either of them would have an issue with me saying this. I think they've probably both said it on the podcast, but neither Matt or Joe have inherently come from a particularly privileged family. They both come from loving families, so good upbringings, but not necessarily wealthy. Joe's dad, I believe, runs a retail store,
liquor store, yeah,
liquor store. Yep, over in the States, or he did. I don't think he does anymore, but he did. And then Matt's parents as well. They weren't particularly well off when he was a kid. And he's got a good relationship with his mum, but he didn't come from a privileged background. So I also have a really good upbringing. I love my parents. And we certainly weren't poor, but we also weren't, incredibly privileged. And I think what that probably helped me to recognize is that there are a lot of people out there who want to invest to to build towards a better future for themselves, for their kids, for their grandkids, whoever. And I guess I recognize that, Matt and Joe are both doing that, and I can do that as well by I guess using my research and using what I really enjoy doing, researching businesses to help other people invest their money to hopefully build towards a better future. That's what I really took away from Matt and Joe. Anirban had a really positive impact on me as well, and he's given me plenty of what Matt and Joe have both given me as well. So I won't spend too long on this, but I worked with Anirban for a couple of years after Matt left the Motley Fool. Anirban became portfolio manager of Motley Fool Pro, and he had a different approach. He had more of a he was very and not to say that Matt and Joe weren't trusting, but Anirban was very trusting of myself and Kevin, who were both working, Kevin Gandia, who were both working on his service at the time. He took not a hands-off approach, but more of a hands-off approach, in that he had a high level of trust in both Kevin and myself to go out there, to do the research, to present him with good ideas, and then say, we like this, we think it should be in the portfolio. So even as a portfolio manager, he did give quite a bit of autonomy to Kevin and myself to really go out there and build these high conviction ideas. That, I think, was a real turning point for me as well in becoming portfolio manager. So you mentioned before, as a 29-year-old, I'm turning 30 next year. Oh God, you're already 30, so I'm in good company. But I think sorry to bring your age into this.
Decent company, we'll say.
Decent company, yeah. I think as a 29-year-old, yeah, it is a young. I am a younger portfolio manager, and I think one of the reasons why I feel more confident in being in this position now is that over time I've sort of built from, as I said, freelance to writer to analyst and now to portfolio manager. Over that time, I've built trust. I think I've built trust in my employer, with Bruce, with Scott, our compliance officer, with director of research. I've also built trust with the member base. So they've gotten to know me. They've gotten to know the kind of companies that I invest in, that I like to look for, my style of investing. I would say I'm predominantly bottom up investing. Predominantly looking at businesses themselves, at the fundamentals. But there is an element of top down. I sort of know what I want to look for. I'll do some negative screens to screen out what I don't want and really hone in on these sort of companies. That can sort of be an element of top down, and then bring bottom up into it afterwards. I think building that trust in the member base has really been a big thing for me. But building trust in myself as well. As a younger individual, 5 years ago, I openly acknowledged that I was not ready to be a portfolio manager. And the opportunity arose where I could potentially put my name in the ring to potentially step into that position, but I didn't want to. I didn't feel ready. So over time, I built that confidence in myself, and I think Anirban's approach, that hands-off approach, and having that level of trust in myself and Kevin really aided in my development in that way. So I'm forever grateful to Anirban for that. He was also very willing to grow others and put himself second, which I think stands to what I was just saying. And also a big believer in David Gardner's rule breakers approach to investing. David Gardner is one of the two brothers that co-founded the Motley Fool 25 years ago, I think. Might even be 28 years ago now, I think. 1993, I believe it was. David Gardner's rule breakers, that is, it's had a lot of, I guess, impact on how I invest. It's not necessarily locking a company into its intrinsic value. It's really about looking about what the future holds for this business or for this industry, and I read a good quote the other day, and I can't remember exactly what it was or who wrote it. So I'm just gonna try and bluff this one, but it was something to the effect of we can't understand things that for which there is we can't understand things for which language has not yet been written. And I can't remember exactly what context that was in, but I think it applies to this sort of investing as well, that there are a lot of companies today with technological advancements that are creating new products, new investments that we just don't understand because they're not a big part of our lives right now. But I think in the future they will be. And I think as investors, and again, this is I think something that I've really taken from Anirban, who has also taken that from David Gardner, is that you really need to have that second level thinking and really think towards the future, and try and apply it to that. Not necessarily lock yourself into the rules of today, but the rules of what tomorrow could be. So yeah, all three of them have had a really positive influence on me and my investing journey. And yeah, I'm forever grateful for them.
Yeah, I mean, I can't even summarize that, so I'll just leave that out
Don't
there
bother.
for listeners to kind of just go back and play again. And I'm sure the three of them will be humbled by your remarks. So I'm going to tie two questions into one. First is, how do you spend your day now? And then I think the easiest way to kind of answer that question is maybe giving us some examples. So maybe like three of the better investments that you've made in your lifetime. What have they been, and what have you learned from them?
Yeah, I'm going to start by saying, I guess, why I enjoy being an investor. I enjoy reading. I read widely. I'm actually undertaking. I'm a candidate in the CFA course right now, so that's taking up a lot of my time. So not reading as many non-fiction books as I would like, but I do intend on getting back into that. I enjoy reading, and I enjoy reading widely. So not necessarily focusing specifically on investing, but just reading about any industry, anything that is potentially of interest, because I think all of that can sort of interconnect. I also really enjoy piecing together information like a jigsaw puzzle of sorts. And I also enjoy thinking about the bigger picture and applying it to the world. So I think that's sort of where the David Gardner rule breakers approach sort of comes in. I also like to learn about things that at the time might not necessarily seem overly important, but might give me an edge, in the future in some way. And I am a competitive person. Maybe that edge is just knowing something that someone else doesn't in the conversation and being able to sort of, throw it in. And to be honest, that's actually one of the ways that I wooed Lauren, who is now my wife. So back in the early days of our relationship, I remember Lauren, within probably a month or two of going on, of becoming girlfriend and boyfriend at that time, she went on a family holiday, and I think she was going to Tangalooma Island Resort in Queensland. And she went away for a couple of weeks, and I thought, I need a way to sort of stay on top of this, to keep the embers burning, so to speak, the flames hot. So what I do is send her some interesting facts that I came across from this British TV show called QI, which was a show hosted by Stephen Fry at the time. And I still sort of enjoy these sort of interesting facts that have no bearing on life. But I'll just give you an example. Did you know that Beyonce has released more perfumes than she has albums?
I did not know.
Yeah, I'm not a big fan of Miss Knowles, but I thought that was interesting, and I'm sure others who are aware of Beyonce's work will find that interesting. Also, all strawberries today derive from 5 plants brought to France from Chile in the 1700s. I'm only going to throw those two facts at you. I don't want to bore this or take this on too much of a tangent, but those are just a couple of the examples of the things that I might send Lauren to keep those embers burning. And yeah, how could she resist, right?
Yeah, well, that's it. I actually heard something similar about the strawberries, but this time with cows. Apparently, there's a rumor that all the American, I think it's dairy cows. There could be other cows for beef. Actually, trace back to 2 bulls or something like that.
Wow.
So yeah, it's fascinating. There's
Sterile.
Yes, Daryl. Hopefully, someone that's listening to this actually knows the answer and can just at us on Twitter. TMF Newmy is your Twitter handle. Okay, cool. So that's fascinating. How about then the second part of the question, which is lessons learned from some of those
Yeah, sorry, I
companies?
took us on a complete tangent there, so I do apologize.
I love strawberries. It makes sense.
So, all right, the first company I think um, it was one of my earlier ones at Pro was Appen, and Matt was also very involved in this one. So I don't take all the credit here, but Appen was a company that we recommended to our Motley Fool Pro service in December 2016. It's still a holding, although we have been trimming that position since I think February 2019 or thereabouts. At the time of the recommendation, it was $2.55, I believe. Basically, what Appen does is, and I'm a shareholder in this company too, by the way, it provides training data predominantly to the global tech companies, companies like Google or Alphabet, Facebook, Amazon, I think is a customer as well, vehicle manufacturers. And basically, this training data is used to help, it's fed into those companies' algorithms to enhance their relevance is a big thing. So search engine relevance. A good example here would be um, June 2019. If you'd searched Corona, it'd come up with a beer, or an alcoholic beverage. Whereas, now you search Corona and it's coming up with the number of coronavirus cases near you today. That's the kind of that's the kind of relevance work that Appen is doing with those sort of companies, and it's doing that across e-commerce to help enhance search results, also social media sort of platforms. At the time, one of the big red flags for us was that it had such high customer concentration, and I don't know, I don't remember the exact figure, but it was probably somewhere around 82 or 83% customer concentration within the top 5 customers. That means that if any of those customers decide to drop off, that's a huge chunk of revenue that's now gone from Appen. By digging a bit deeper, what we found was that yes, it had a high level of customer concentration, but within those customers, it actually had multiple, potentially thousands of individual projects that it was working on. So it wasn't necessarily it wasn't necessarily going to be Facebook's decision that, okay, we're not going to use Appen anymore. It might be an individual project within Facebook that said, okay, we're not going to use Appen anymore. I guess Facebook or any of those big sort of tech companies can flick the switch when they want to, so there is still that risk. But in our eyes, that risk was somewhat mitigated. So I think in that sense, yes, the lesson was it had a very high level of customer concentration, but by digging deeper, we were actually able to find an edge where we found an area that probably wasn't quite as understood by the market as what we felt we had an understanding of. We also continued to buy it along the way after it made a number of transformative acquisitions that we thought were very value enhancing. So we built our position, and as I said, started trimming due to position sizing, as well as at the beginning of COVID, we sold because we felt that we sold some, I should say, because we felt that some of its customers would likely be hit by a lower advertising revenue. Company is struggling a little bit at the minute. Some of those customers still haven't come back as much as they'd like. Our position has become far less important to the overall scheme of the portfolio. I think it's about 2 or 3% at the minute, so it's not huge, hugely bearing on the direction of the portfolio, but it's still one we hold. Another company that we invested in earlier as well at Pro, and I'm also a shareholder in this one, is WiseTech Global. I bought this one at $4.69. Personally, I think it's up about $31 or $32 at the minute. And this company provides a platform for logistics service providers around the world. Its platform is known as CargoWise One. And basically the premise is that customs is extremely complex. So if you're ordering something from America, that item, that item might have a number of different components that come from various places in the world, which all rely on customs to get to the warehouse or to the manufacturer. Manufacturer then has to send that, from maybe into a truck that then gets sent through to a ship, which then gets sent on a plane, so on and so forth. There are so many different stages of this journey along the customs line that make it a very complex process. And what WiseTech Global does is provides a platform that digitalizes that. It removes that paper trail and digitalizes it, and therefore significantly simplifies that process. Actually, for people who do want to listen, there was a really interesting podcast by Patrick O'Shaughnessy on I think it was Invest Like the Best. He interviewed a guy named Ryan Peterson, who was the founder of Flexport, which is a technology platform for global trade. I think it was about an hour or an hour and a half podcast. That was a really interesting listen, and I think gave a lot of insight to just how complex this industry is. So I don't know, maybe you can link that.
Yeah, sure.
Link that in the notes. But I think as well, one of the things that probably I felt we had a better understanding of than what some others in the market might not have such an understanding of is that acquisition side of things. This was a very acquisitive business, and it has slowed down in over the past 12 months or so. But on face value, it didn't really seem like those acquisitions were adding a lot of value, because at times the revenue generation from those companies was actually declining afterwards, after acquiring these businesses. And that's generally not what you want to see in an acquisition. But stepping back, what the company was actually doing, it was actually acquiring businesses that it would otherwise have to invest research and development dollars in to acquire, to build. And by acquiring it, it was just a much quicker and smoother process than by building it itself. It was changing the business models of those acquisitions, and therefore, it sort of had to take a short-term hit to make a long-term leap, rather. So I think that was one fact that probably appealed to me with that business. I think probably the last, or one of the last important messages or takeaways from that investment is the importance of net retention. This company has continuously generated more revenue from its existing customer base over the years, and it's consistently providing this chart in its updates and its presentations that shows the different user cohorts. From I think FY14, or might even be earlier than that onwards, just how each of these cohorts is spending more and more and more each year. And I think that's really valuable for any business, because obviously to increase the usage of an existing customer is cheaper and easier than by going out and acquiring entirely new customers. So I think that as well is something that I've applied to, that lesson is something that I've applied to a lot of different investments along the way as well.
And so we've got Appen, we've got WiseTech, both businesses that I know pretty well. Pretty well. Do you have a third company for us?
I'll throw in a third, and this is actually a company on the NASDAQ. I think it's the NASDAQ, might be NYSE. Maybe you can check this, but Twilio. Yep. And Twilio is basically building the platform that revolutionizes the way that we communicate. So the way to think about this is, let's say you've got virtually any app on your phone now. There's some form of communication, whether that be a text message or a WhatsApp message or some sort of phone communication. Airlines will send you a text message saying your plane has been delayed, this and that. So companies are enhancing the way that they're communicating with their customers, with any other stakeholder as well. So communications is coming a long way, and it's really advancing. The problem that the founders, including Jeff Lawson, who is now the CEO, or still the CEO, what he found was that entrepreneurs, as they developed these apps or these communications abilities within these apps, was that they were constantly having to reinvent the wheel. They would, every time they coded these apps or these codes, they would constantly have to code a new way to apply messaging. So basically what Twilio does is instead it acts as like a platform it provides an API from which entrepreneurs can literally just copy a code into their apps, and it will use Twilio's underlying technology to do it. It's not a one size fits all, and developers can obviously adapt it to whatever they need their individual products to do. There's even things like smart bins. When a bin becomes too hot or gets to a certain fill line, it can communicate with the garbage truck to say, hey, come and collect this, and it will optimize its route. So there are a lot of different ways that this can be applied. I think what this and it's a more I guess complex business than that. They've also got the networks in which they run. But the lesson I guess from that I took away was the power of platforms, and just by centering yourself in that position and becoming the platform from which others can build is a really, really valuable position to be in. And yeah, there's others that are applying that as well.
Yeah, dude. I use Twilio, but I use Twilio as an extension of its email channel. So
Mm.
omni-channel communication is basically Twilio, and one
Mm-hmm.
of those channels it's known for is like SMS and text and whatever. But
Mm-hmm.
also they acquired SendGrid.
Mm.
So SendGrid is like I think it's like the world's biggest email server for
Mm.
developers. And so basically when we send emails, we send different types of emails. And
Mm.
like if you get, say, for example, you get like a password reset email from a Rask server, it actually comes via Twilio. And so our website pings Twilio, which then sends it across. And if we didn't have Twilio/SendGrid, it's just so much more complicated. Not only that, your server, which is running other stuff like serving web pages or processing payments or whatever, it'll just be smashed by constantly sending emails to users if you've got thousands and thousands of users, right? So that's how we use Twilio. And it's more like the SendGrid side of the business. But that's fascinating. Yeah, right. So you got three really interesting lessons learned from three interesting companies. So there's more than one. There's more than one lesson from each. But I think we can take a lot from them, like Appen, basically getting that variant perception. WiseTech, you got that through understanding the buy versus build trade off, and also kind of maximizing efficiency and simplifying a very complex thing, and having that high net retention rate as a result. The other thing, obviously, with Twilio is the importance of platforms, right? Like, so
Mm.
I think there's many examples of this, but the Australian example would be Xero. So I say Australian, we both know it's Kiwi.
We'll claim it.
We'll claim it. If it's good, we'll claim it. Yeah, like Xero allows you as a developer to integrate, right? So it's very hard for businesses to reach that point, but once they get to the tipping point, Malcolm Gladwell, you will see that they kind of take off in terms of more and more developers, and it creates this kind of vicious network effect and this flywheel that kind of just spins out crazy cash flow over time. Just conscious of time here, mate. We have a lot of questions to ask you. I think I'm going to have to get you back for another chat. But maybe so I've got a few here that I wanted to ask you. Maybe in the interest of time, go for it. What were you going to say?
I was going to say you mentioned my kids before. I've got twin boys. They're nearly 7 months old, and also a nearly 3-year-old daughter.
3 under 3.
Yeah, I know you
Three-pointer.
were. I know it's a busy household. I know you were keen to ask me, I guess, about how I think about investing for them.
Yeah, let's do that one. So how do you invest for your kids, and is that different to how you invest for yourself?
So look, I'm being perfectly honest. I haven't invested in businesses for them yet, or in a portfolio specifically. Part of that has been, I guess, just trying to think about the most efficient way to do that, tax wise. I'm not a tax accountant, but basically, if I was to hold shares in my own name for my children, if I sell them, then obviously I'm taxed heavily, and then if I invest in their name, then I think it's taxed at the maximum rate. So it's not the most efficient way. There are other ways that we have thought about doing it, but just haven't got around to doing that part yet. However, there are things that there are ideas that I really like about how I intend on helping my kids to get investing in the future. And as I said, my kids are really young at the minute, so they're 3 under 3. Two of them, spend more time, pooing their pants and sleeping than anything else. Than and Ava is just not yet at that point where she can comprehend this sort of thing. But I think there are still things that you can start to work on. And one of the things that I'm keen to teach Ava is my daughter's name. One of the things that I'm keen to teach her is about delayed gratification, and I think that's a really important element of investing itself. There was a really interesting case from quite a few years ago where this professor would put a marshmallow in front of all these children in a classroom and say, you can eat it, or if you leave it for 15 minutes and I come back and it's still in front of you, I'll give you another one. So either eat one now or two later. And that's really what investing is, right? And what that study found is that kids who have or are taught delayed gratification, they have tended to perform better academically. They also have tended to earn more money in their lifetime. They live happier and healthier lives, and they're also less prone to diseases like obesity and also drug use. I think there are ways that, and I will say, this is very much a work in progress. If I put a marshmallow in front of Ava right now, she will eat it. So there's no waiting. So it is very much a work in progress. But I think what I want to sort of go down the path of is helping her to develop that skill and that mindset. So one of the ways that I think she can do that is by reframing it. So one of the examples that the person who did that study provided was, rather than thinking about it as a marshmallow in front of you, think about it as a fluffy cloud. You can reframe it. 15 minutes goes by. Now you can think about it as a marshmallow. You can also distract yourself. And I think a good way that, a lot of investors, I think, get distracted by the market noise, and also just that constant access to stock movements, to what this stock is doing today or that stock is doing yesterday. I think just distracting yourself and getting away from it. The less often you check your portfolio's daily movements, the better off you will be in the long run. And the happier life you're going to lead, because you're not feeling so stressed out all the time. So I think distracting yourself, getting out for a walk, or just finding something else to do other than focusing on that, and likewise focusing on that marshmallow. Find something else that you can distract yourself with. I think the other lesson from that as well is that human beings thrive not only from considering what the future holds, but also planning for it. And I think we probably saw that with the pandemic. I struggled to get toilet paper in my household for quite a while, as I know a lot of other people did.
But you stocked up. I remember your office was full of toilet paper.
I did stock up a little bit, but then when I tried to stock up more, because I thought that
it was heaps.
Oh, here we go.
You took it all.
Here we go.
The local Woolworths was empty because of you.
Maximum two cartons at any time, mate. But I think that's what we're really trying to do as investors. We're trying to plan for the future. So we're sacrificing now. We're sacrificing that ability to spend now to save for later. And that how that relates to this test. This study was one marshmallow now or two later. I think by teaching her these sort of things early, she can sort of get into that mindset earlier. And I'm saying Ava because she's sort of approaching that stage, but my twin boys too. I think also teaching them in ways that they'll understand. Ava asked me recently why mummy and daddy work, and we told her it's because we have to buy her toast. That's the only way that she's going to understand, because we have to buy your toast. So sort of teaching them in ways that they will understand at their level at that time. The other idea I've actually taken from Anirban, and I don't think he'll have an issue with me sharing this, but I really like this idea and I think it has a lot of merit to it. So Anirban's idea was to basically present his kid with 4 ideas. So it's ideas that he himself has researched, he likes. So that might be let's say a Disney, a game company, a supermarket, and something else. He likes these businesses, and he's going to present her with these ideas. It might be a one or two paragraph explanation for each of those, and he will put that decision to his kid and say, all right, which of these do you want to invest in? Now it's guided because he's done the groundwork and he's happy for her to invest in any of those businesses. But by the same token, she's actually the one making the decision, and she is the one thinking that through. Now, it might be something that she knows about. Maybe it's a Roblox if she plays Roblox on her mobile phone or something like that. So she might make that decision based on that. Or it might be because, maybe I direct her in, all right, think about this. Getting her to actually explain to me, why are you investing in this business? Why are you making that decision? I think that's a really good lesson with a lot of merit to it to actually help them get into that investing mindset.
Hmm. There's a lot there. I'll give you a hot tip. You can just own shares or ETFs at a low turnover, so you don't sell them or whatever. Hold them in your name, but you can actually do a bit of legal letter work, paperwork, and basically say that you're holding them as a beneficial interest for your miner. But the key
Mm.
is just make sure that their income doesn't go over, say, $500 a year, because that's when they'll get taxed more for unearned income.
Mm.
And then when they hit 18, the transfer of interest is pretty simple. You just transfer it into their name, so you shouldn't need to pay the capital gains tax. I'm not an accountant. Speak to your accountant.
General advice only.
General advice only. There's the disclaimer,
Yeah.
RG146. We've come full circle. Now, I tell you another one that's a really interesting one with Anirban. I might ask him about that. Is when you go to the store, right? And explaining like what's your favorite, and did you know that you can own part of this? Or that's probably a little bit further on from where Ava is at 3, but as they get older, maybe in the teenage years, that's probably something that you can do as well. I really like that idea of giving them a choice. It's one thing that we've said for people to do as well over the years is basically you just write like a small little summary and make it companies that they know. There has to be companies that they know, because that's the essence. That's to your point at the beginning about cutting through the noise. Like, it's not stock symbols, it is businesses. So how do you do that? Well, you give them something that they know, and then they can associate with that. That's
And
cool.
and also explain it to them as though they're a 5-year-old, because they are a 5-year-old.
Yeah.
You sort of got to explain it in simple terms that they will understand.
No, you just say, hey, you're trying to get as close to the efficient frontier as you can. And what's the beta of the stock? Oh, that matters because no one cares. Yeah. So all that stuff, like, that's super important, right? And I feel like she's in good hands with you and Lauren there. I feel like we've got time for me to ask. Well, I've got 2 more questions I have to ask. So maybe a quick one is, I know you have some experience with small business. Um, uh, how do you think running a small business compares to investing in bigger businesses? Like, have you drawn any parallels with that over time?
Yeah, I think it's really important. My wife runs her own business, and I am aiding in that. And I'll be perfectly upfront. She has done the bulk of the groundwork. I've sort of been there to help strategize, help with some of the financials, but she has been very much so the architect of it all. So full credit to her. But that has been my experience as well, and the experience that I've gained from that. Yeah, it has helped me with investing too. And I think probably some of the bigger lessons to take away from there is, one, try and remain lean. Don't overextend yourself. And I think that's a really important thing, particularly for people who are starting up and also people who are looking at small cap stocks in particular,
Mm.
because cash is king, right? We know that saying, cash is king. Without cash, how can a business function? How can it pay its staff? How can it, buy equipment or buy assets? How can it invest for the future? So that's been one of the key takeaways here for me with small business, and I'm conscious of time as well, so I'm going to keep this short. I think as well the other lesson too is the importance of taking on good staff. So building a good support network and a good team, making sure that you've got the right people on the bus. As a small business, and again applying this to I guess small cap investing, if you get bogged down with poor team members, then you're going to have your hands full. You're going to be putting out fires here and there, which you really don't want. You want momentum to be on your side, and you want it all going that way. You don't want things holding you back. We both learned some lessons, I guess, in a small business sense in the earlier days, and I think that's really something that we've improved on. Lauren's excellent at interviewing now, and she's got a pretty fair idea of what she's looking for, and also what she thinks the person that she's interviewing is looking for, to try and get that right fit. And I think that's really important, and a good lesson for small cap investing too.
Yeah, totally. If you think about it, if there's a business of 3 people, that's 30% of the business is one person. So you got to make sure you have the right 3 people. Obviously, and as it grows, each person becomes a smaller cog in a bigger wheel. But at the same time, at the very top is where the decisions are made. So there's obviously it kind of focuses in on certain people, so you want the right people. Yeah, it's cool. I think like that's maybe something we can follow up on next time as well. Okay, so I've got one more question. Actually, so if people want to find out about Motley Fool Pro and what you're doing, I don't think they can join Motley Fool Pro directly, can they?
Not directly. So we do reopen it sporadically. I don't know when the next reopen is, but obviously there are other services that they can join. Share
Like
Advisor is
Advisor.
one. Dividend Investor. Extreme Opportunities as well is a really good one. That's run by Kevin Gandia. He's the person that I used to be a research analyst alongside on Pro. He's still working on Pro as an analyst. He is also the head of Extreme Opportunities and also our director of research. Really respectable guy, really good investor. I really like the Extreme Opportunity service, and that one's always open. So
yep, cool. That's fool.com.au, fool.com.au. I'll provide a link in the show notes as always. Mate, one more question. Last one is if you could go back to your younger self, maybe it's 10 years ago when you started, maybe it's earlier, maybe it wasn't even that long ago, maybe it was when you were 3. What is the advice that you would have given to yourself, whether it's business, life, investing, money? What would you say?
One thing I'll say, my parents were really good. So as I said, we didn't come from an incredibly privileged position, but it was a comfortable upbringing. One of the things that my parents were really good at is, I guess, teaching us to save and how to respect money. And I wish I had have paid more attention to that at the time. I distinctly remember them, at the time saying things like, do you really need this? And I might spend $100 on that and get a week of enjoyment out of it. And then, it's in the cupboard and locked away. $100 doesn't sound like much. And, to some people it isn't, but as a young kid, it really is. And it's also that lesson, just that mentality of actually saving and putting it towards something in the future. So as a lesson to a younger me, I think teaching myself to be more respectful of that and to really take advantage of that earlier saving. I think that could have, put me in a better position to potentially get a better car. Initially, I had a number of bombs that that cost me a lot of money in my earlier years. Had I been able to afford a slightly better car, I think that would have saved me incrementally down the track as well. I think the other thing as well is I was hard on myself coming out of year 12 in my earlier adult years, as I know a lot of younger people are. I think you come out, you sort of know what you're doing in school, and then you come out and you don't know what you want to do. You sort of feel lost. And I was hard on myself. As I said, I was down on it. I was really thinking, what the hell am I going to do? I don't know what I want to do now. Completely directionless. Things have worked out well. I'm where I want to be, but I wish I wasn't so hard on myself, and I wish I had have, I guess, just taken life as it came a bit more.
Yep. Yeah. Cool. I agree. You were hard on yourself, but yeah, it's hard to know how.
And I think a lot of young kids are, and I think a lot of them shouldn't be.
I think you got to learn to fail, right? Like,
yeah,
you're. I mean, this is a sample size of 2. Indo Mines was obviously a success, but Hot Rock Limited, geothermal energy, if we come full circle there, wasn't a success. And you had to fail to find out what did work. You had to experience some success. As in investing, it's as in life, right? Like, you studied quite a few different things before you found your calling. I went to 5 different undergrad unis.
I was going to say, you've taken just about every course that Australia has to offer. So,
well, I've got a few expensive pieces of paper that hang on the wall nowadays. But I studied social science, engineering, science, engineering again, did civil, did technology, did economics. I mean, multidisciplinary
then applied
learning.
Finance, of course.
Basically, an 18-year-old Charlie Munger. That's like yourself. Healthcare, accounting, like maths. Like, man, we just
look, you don't die wondering, right? You experience something, you realize that it doesn't work for you, and you move on to something that does.
Yeah, And I think a lot of the times, particularly for younger people, there's so much focus. Get a really good high school score, get into a good uni, do this job because you'll earn a lot of money. Those types of things, in my experience, very rarely result in a really happy person and someone who thrives in their occupation, which consumes the majority of their life.
Mm.
So, we're not telling everyone to do, a uni dropout and go and start Facebook, but it's just, I think that's kind of the experience that I've got from you. Um, cool, mate. This is heaps of fun. Um, did you, when you asked to come on the podcast, he had to ask, by the way, I was never going to let him on. Did you think that,
Yeah, right.
did you think it would be this much fun?
No, it's been really good. I to be clear, that is not how this happened. But no, it's been a lot of fun. It's I think in particular for younger investors who are trying to break in, and also just for people who are just trying to find, I guess, an entry point. I think it's really important to realize that everyone comes from a starting point. No one is an expert, even the so-called experts. Where no one is an expert. You do continue to learn as you go, and you got to start somewhere. So it's never too late to start. Yeah, now's a great time.
Cool, mate. Love the advice. Thanks for taking some time to join me.
Thank you.